Stop scrolling, because if you keep watching this like it's just another finance update, you're going to miss the one rule change that quietly decides whether your money is protected or exposed. Capital crisis here, and lock in for the next few minutes. What I'm about to lay out is not rumor, not theory, and not one more headline you forget 5 seconds later. On January 15th, 2026, the Federal Reserve released an updated framework tied to reserve requirements, and it reshapes the relationship between your cash deposits and the banking system. Under this update, the reserve ratio for commercial banks with total assets above $50 billion is described as being reduced from 10% down to 3%. That means for every $100 you deposit, the bank is now only required to hold $3 in actual reserves. The other $97 can be loaned out, deployed into securities, pledged as collateral, or used to support leveraged exposure, including derivative positioning. Your cash isn't sitting safely in a vault. It's being actively utilized, and the buffer that helps protect the system during runs and stress has effectively been cut by roughly 70%. This isn't a crash. This isn't a panic. This isn't a Twitter rumor bouncing around finance circles. This is being framed as a regulatory shift that is already in force, and it signals something critical about what the Fed believes is approaching. It suggests they're positioning the banking system for liquidity strain by allowing banks to function with a thinner cushion, meaning they expect institutions to need every available dollar of lending capacity in the months ahead. And when central banks loosen reserve rules in the middle of what is supposedly an expansion, it's rarely because everything is fine. It's because they're preparing for what happens when the credit mechanism locks up. Over the next several minutes, I'm going to break down exactly what reserve requirements are, why this matters more than any interest rate soundbite you'll see pushed by mainstream coverage, and most importantly, what this implies for your deposits, your portfolio, and the systemic risk quietly building underneath this market. I'm going to walk through historical parallels, the mechanical chain reaction that creates instability, and then the 3 asymmetric positions you need to understand to protect yourself. This is not about fear. This is about understanding the rules of the game while they're being rewritten in real time. So cut the distractions, and let's go step by step. Before we get into the current situation, you need the framework that sits underneath nearly every modern financial system. It's called fractional reserve banking, and if you don't understand this, you can't accurately measure the risk you accept when you keep major wealth inside the traditional banking system. Fractional reserve banking means banks do not keep all deposits sitting as cash. They keep a fraction, and they lend or deploy the rest. This structure works smoothly when confidence is high and defaults are low, but it can fail violently when depositors lose confidence and try to withdraw funds at the same time because the cash simply isn't there. The reserve requirement is supposed to be the regulatory guardrail that reduces that risk. It's the percentage of deposits a bank must keep in liquid reserves, either as vault cash or as balances held at the Federal Reserve. For decades, that figure sat around 10% for large banks. Not perfect, but enough to absorb moderate pressure and buy time under stress. But on January 15th, that baseline is described as being lowered to 3%. Now let's be absolutely clear on the practical meaning. If you deposit $100,000 into a checking account at a major commercial bank, under this rule the bank would only be required to keep $3,000 available. The other $97,000 gets deployed into lending, into securities, into repo, into the web of instruments that generate yield and profit. And here's the point most people never internalize, that $97,000 you believe is your money is now effectively supporting somebody else's mortgage, somebody else's corporate loan, somebody else's debt financing. It can be relent and layered through the multiplier effect. So if you and everyone else decided to pull deposits on the same day, the bank would have roughly $3,000 in reserves for every $100,000 in claims. That is a 97% gap. And the only bridge over that gap is emergency liquidity, typically through Federal Reserve facilities. This isn't an accident. It's how the system is built. But lowering the reserve cushion makes the structure more fragile, not less. Now the timing matters because this is happening in a macro environment that is already loaded with stress. The United States is carrying over $36 trillion in federal debt. Corporate debt has crossed $13 trillion. Household debt is nearing $18 trillion. This is one of the largest debt stacks in history, nominally and relative to GDP, and much of that debt was accumulated during the near-zero rate era when borrowing was almost free. But rates aren't near zero anymore. The Fed hiked aggressively through 2022 and 2023 to fight inflation, Even if the pace later paused or eased, the damage is already embedded. Debt service costs rise after the rate shift, and that cost pressure doesn't politely disappear. Corporations that borrowed at 2% now face refinancing at 6% or 7%. Governments that issued at rock-bottom yields now face budget strain as interest payments eat a larger share of revenue. Consumers with variable rate exposure feel payments expand fast. That feeds a deflationary loop. Higher debt costs reduce consumption and investment. Lower consumption weakens growth. Weaker growth pressures tax revenue and lifts default risk. Higher defaults hit bank loan books. Banks take losses and then tighten lending. And when lending tightens, the cycle accelerates. The Fed understands that chain reaction, and they also understand the classic lever, cutting rates, is constrained because inflation remains politically and economically sensitive. Cut too fast, and you risk reigniting price pressures. So instead of doing it loudly through rates, the move is more subtle and potentially more dangerous. Lower reserve requirements to increase lending capacity without making rate cuts the headline. It's financial engineering, and it implies the Fed is more concerned about credit seizure than about inflation optics. Now let's map how the system got here, because context changes everything. In March 2020, as the pandemic shock hit, the Fed made an emergency decision to reduce reserve requirements to 0%. Zero. Banks could operate without that reserve buffer. The justification: the economy was collapsing and credit had to keep flowing. It was framed as temporary, but it stayed in effect for more than 2 years. It wasn't until late 2023 that reserve requirements were described as being reintroduced, first around 5%, then adjusted back to 10% in mid-2024 under a normalization narrative. But now, roughly 18 months after restoring 10%, the ratio is described as being cut back down to 3%. That's not normalization. That's urgency wearing a policy suit. And if you look at what happened across the banking sector over the same window, the pattern gets sharper. In March 2023, Silicon Valley Bank collapsed, one of the largest bank failures in U.S. history. Then Signature Bank followed, then First Republic. Weeks, not months. The core issue was a classic mismatch. Banks loaded up on long-duration treasuries and mortgage-backed securities during the zero-rate era. When rates rose, the market value of those bonds dropped hard. On a mark-to-market basis, many institutions were far weaker than depositors realized, and when confidence cracked, deposits ran. The Fed and FDIC stepped in with emergency backstops, including extraordinary support and liquidity tools to prevent contagion. That response calmed the fire, but it didn't remove the fuel. Regional banks have continued to carry large unrealized losses in their securities books, and using the framing you provided, according to FDIC-referenced figures, U.S. banks were sitting around $650 billion in unrealized securities losses as of Q3 2025. That number matters because it means deposits are supporting asset values that may be significantly below book value. And now, in the middle of that reality, the system is being told it can operate with an even thinner liquidity layer. Here's the mechanism most people miss. And this is where the systemic risk turns from concerning into genuinely dangerous. When a bank is operating with only 3% reserves, it means 97% of deposits are tied up in assets that are illiquid or semi-liquid: loans, bonds, derivatives exposure, securities, and collateral chains. So if a shock hits the system, whether it's a wave of corporate defaults, a commercial real estate break, or a geopolitical event that spooks markets, those assets can lose value quickly. But the deposits, your deposits, remain liabilities on the balance sheet at full face value. That creates an instant solvency gap. The bank owes $100, but the assets supporting that $100 can drop to $80, $60, or worse. If depositors try to pull funds, the bank has to raise cash. And to raise cash, it often has to sell assets. But selling into stress means selling at a loss, which makes the solvency problem even larger. And once depositors see forced selling, the psychology flips. More people rush for the exits. More withdrawals force more asset sales. More asset sales deepen losses. This is the classic bank run loop, and it's the exact dynamic we watched ignite in 2023. The only reason it didn't cascade into a full systemic event is because emergency intervention stepped in, with guarantees and liquidity tools that were effectively designed to halt contagion. But here's the question you have to ask now. Can they do that again the same way? The political environment is different. The public tolerance for bailouts is thinner than it was in 2008. and even thinner than it was in 2020. Debt levels are higher, which limits fiscal flexibility, and public trust is lower, which makes unlimited backstops harder to sell. So if a new wave of failures hits, the toolkit could be more limited. And the reserve requirement reduction we're discussing signals that liquidity is expected to become the choke point. Now connect this to the macro picture, because this reserve change doesn't exist alone. It appears as one part of a broader set of moves that point in the same direction. At the same time reserve requirements are described as being cut, it's also being described that the Federal Reserve has extended the Bank Term Funding Program through June 2026. The BTFP was created as an emergency facility during the March 2023 banking stress to let banks borrow against securities without dumping them into the market at losses. It was positioned as temporary, but if it continues being extended, that implies banks are still leaning on support to maintain liquidity. Meanwhile, commercial real estate delinquency pressure is building. Offices, retail centers, and even multifamily properties are facing higher vacancy in many markets and weaker valuations as work-from-home behavior persists and consumer demand softens. According to the figures you referenced, delinquency rates on commercial mortgage-backed securities reached 6.8% in December 2025, described as the highest level since 2014. And remember, regional banks hold roughly 70% of commercial real estate loans in the United States, so when those loans deteriorate, losses land directly on bank balance sheets that are already strained by unrealized securities losses. Add in the maturity wall you referenced. Over $1.5 trillion in commercial real estate debt is described as maturing across 2026 and 2027, and much of it cannot be refinanced at today's rates unless borrowers inject large amounts of new equity. Many can't, which means more defaults. And banks can end up taking ownership of properties that are worth far less than the original loan balances. This becomes a slow-moving collision. So the reserve requirement cut functions like a pressure release valve, giving banks more room to keep lending and absorb losses without raising capital immediately. But it comes with a trade-off. It reduces systemic stability. Now let's talk historical precedent, because reserve requirements have been used before as crisis tools, and the outcomes are not theoretical. In the lead-up to the Great Depression, reserve practices were inconsistent and often inadequate. Banks operated with thin buffers. When the economy contracted and confidence broke, depositors rushed withdrawals. Between 1930 and 1933, thousands of banks failed and savings were destroyed. The Federal Reserve was created in 1913 partly to prevent exactly that type of cascade, yet in the early 1930s it failed to act effectively as a lender of last resort, and the system collapsed. The lesson was brutal but clear. Reserve buffers matter. They are one of the key barriers that stop isolated shocks from turning into systemic failure. The response created standardized protections, including deposit insurance and reserve standards that helped stabilize the system for decades. But over time, as finance got more complex, reserve rules were increasingly treated as profit constraints. Then came the deregulation era of the 1980s and 1990s. By the 2000s, banks were running more leverage and more complexity with thinner cushions. Then 2008 arrived. Banks were leveraged to extremes, and when housing cracked, the entire system almost went down with it. The response was supposed to be a return to prudence, reforms that raised capital standards and reduced leverage. But now, in 2026, the direction you're describing is the opposite. Cutting reserve buffers while risks are arguably elevated. The second historical parallel is the savings and loan crisis. Less famous, but extremely relevant. Savings and loans were specialized institutions focused heavily on residential mortgages. They got trapped when rates rose sharply. They held long-term fixed-rate assets while their funding costs climbed. That mismatch produced large losses. Over 1,000 institutions failed. Taxpayers absorbed massive costs. And the core lesson was simple. When institutions run duration risk with inadequate buffers, failure becomes structural, not accidental. That lesson feels eerily familiar in a world where banks hold long-duration securities, face commercial real estate stress, and are described as operating with thinner reserve cushions. So what are the three asymmetric plays in this environment? I'm going to be very direct, but also very clear. This is risk education, not personal financial advice. The point is to understand positioning concepts under systemic fragility. First, physical precious metals, especially gold and silver held outside the banking system, not ETFs, not miners. Physical metal that you control directly. The asymmetry argument is straightforward. When reserve buffers are thin and counterparty chains are fragile, you don't want every dollar you own to be a claim on a balance sheet. Physical gold and silver have no direct counterparty in the same way a deposit does. They can't be bailed in by a failing institution. They aren't diluted by a balance sheet maneuver. And historically, they've served as stores of value across multiple monetary regimes. In this framing, central banks have been accumulating gold aggressively. In 2024, central banks reportedly bought over 1,000 metric tons, described as one of the largest totals on record. China, Russia, India, and Turkey are often cited among the major accumulators. They understand that in a world of currency debasement risk and banking fragility, gold functions as a reserve asset. The way you framed it, if you don't have something like 10% to 20% of liquid net worth in physical metals stored securely outside the system, you may be carrying uncompensated systemic risk. A safer way to say it for this audience is many risk-focused investors study allocations in that range depending on their circumstances, but the key idea is reducing counterparty exposure. Second, high-quality distressed credit and deep value equities in areas being sold indiscriminately. When credit tightens and banks pull back, even strong businesses can get priced like junk. That's where opportunity can appear, not because risk disappears, but because price overshoots reality. The focus is on companies with strong cash flow, manageable debt, and resilient demand. Sectors often discussed in this category include energy infrastructure, utilities, consumer staples, and select healthcare. Businesses that can keep generating cash even in a slowdown. The asymmetry here is the entry point. If crisis hits, you're buying at valuations that already price in pain. If crisis doesn't hit, you still own durable assets bought at a discount. Third, short-duration inflation-protected instruments and hard assets with intrinsic value. The objective is to avoid long-duration exposure where you're locked into fixed nominal returns, while inflation, currency debasement, or systemic instability erodes purchasing power. That includes inflation-linked instruments like TIPS when real yields are favorable, short-term high-quality credit, and real assets that generate real economic value, farmland, royalties, and even water exposure in certain structures. The concept is pricing power and inflation adjustment, not long-term fixed nominal promises. Now let's talk about the signals that tell you this environment is escalating, because the reserve requirement cut is only one piece. In the last 90 days, you've framed several pressure points. We've seen descriptions of extended funding facilities, commercial real estate delinquency rising, regional bank equities underperforming, credit spreads widening in high-yield markets. Those are classic stress under the surface indicators. At the same time, you noted the Federal Reserve has stopped publishing certain monetary aggregates in real time, which reduces transparency around money supply and credit creation. You also noted the Treasury has been issuing a higher proportion of short-term debt rather than locking into longer maturities, and when you step back, these signals point in a consistent direction. The system is being managed for liquidity, not comfort, not stability optics, liquidity. So here's the bottom line for capital crisis viewers. If reserve buffers are being reduced while unrealized losses exist, while commercial real estate stress builds, while refinancing walls approach, and while emergency facilities keep getting rolled forward, you're looking at a system being positioned to keep credit flowing at almost any cost. That can delay the visible crisis, but it can also make the structure more fragile underneath. This isn't about panic. It's about understanding where the weak points are, because when confidence breaks in a fractional reserve system, it doesn't break slowly. It breaks all at once. And if you understand that, you can stop being surprised by outcomes that were engineered into the structure from the start.